Hey, so you ever wondered how you can start trading with a small account size? Well, I have the answer for you here. I'm John Napolitano. I am the options instructor at Stock Trading Pro, and we are here to help you on your journey to trading. So everybody has to start somewhere, right? And most people start obviously with a small account size, unless you win the lottery, in which you don't really need to trade anyway. So what we're going to do is show you exactly how to trade options with a small account size. Many people talk about trading stocks, but sometimes with stocks, you need a larger account size in order to make any money. In order to get the leverage you need, in order to have a brokerage account where you have a decent capital to trade, you usually need several $1,000s, up to $25,000 actually, in order to get that leverage. With options, you already have embedded leverage in each contract. One contract equals 100 shares. So if you think about it, one contract, you're essentially borrowing the shares. You're borrowing the stock in a way. So this gives you implied leverage. So for those of you who are unfamiliar with options or how they work, feel free to watch these videos, like and subscribe to this channel, and check out our education and some of the stuff we offer in the link below. So let's jump into it. I'm going to show you a pretty simple strategy that anybody could follow, and it'll help you potentially generate a little bit of revenue every single month while you're going on this trading journey. So we talk about this one rule in trading, and it pertains to both stocks and options. It's called the 60-20-20 rule. And basically, a lot of new traders overlook this because they're so busy trying to pick stocks that they kind of forget that the whole market is sometimes more important. In other words, 60% of the movement of any stock, anytime, anywhere, has more to do with what the market is doing on that particular day. When you think about it, a rising tide lifts all boats, or the other way around. And that's kind of what I'm getting at here. So when markets are up, most stocks are up. When markets are down, most stocks are down. There's obviously exceptions, but for the most part, the market kind of dictates what direction the rest of the stocks are going to go in that week, that particular day. There's obviously exceptions with earnings and stuff like that. But the problem with a small account size, and the reason why I'm bringing this up, is because you can't get caught up in that when you have a small account size. When you have a small account size of, let's say, under $5,000, you cannot afford to take on single stock risk. If you were to buy options in Tesla or just shares in Tesla, for instance, if God forbid Elon Musk gets hit by a bus, what do you think are going to happen to those Tesla shares? They are going to go very, very bad for you. So you can't really afford to get blown up by any particular headline news risk that might affect one single stock. So you really need to stick to that 60% rule or the 20% rule, which has to do with the sector that the stock is in. The other 20% of any stock's movement has to do with the group that it's in. So sometimes technology's up, sometimes energy's up, sometimes basic materials, sometimes healthcare is down, and so on and so forth. And if you're caught up, if you happen to own a stock within that group, again, rising tide lifts all boats. That means that that particular day, you might actually be having a good day, despite the fact that maybe it isn't the best stock that you picked. So the other 20% really has to do with the group that you're in. And that's kind of what you need to stick with. That last 20% that I'm talking about, of the 60-20-20 rule, has to do with the stock itself. So stock picking at some point does matter. However, it doesn't matter as much as you think. I'm showing you right now in front of you a chart of XLE. This is the energy ETF. This particular ETF represents about 60 to 70 energy names. And you can see that since April, when the whole market, remember the 60-20-20 rule, you see the whole market went down back in April. The energy stocks were no different. They went down just as much as the broader stock market. But you can see here that ever since April, it has staged a bit of a recovery, but not as much as the other groups. If I was to compare, for instance, I'm going to do this really quickly for you. If I was to just compare XLE to, let's say, QQQ, which is the NASDAQ 100, which is technology, you can see that back in April, we were down here, And you can see the exponential growth here that, the QQQ has had, kind of parabolic here. It's up 35%, by the way, off the lows here. Energy actually has some room to run. If we kind of go back to energy here, you can see what I'm talking about. It has room to run because it has not made new highs yet. It still has a little bit of upside here. And, with sector rotation being what it is, this might be a good opportunity. So that's why I picked this particular group. But as a small account owner, you don't have to necessarily drill down to individual stocks. You can buy the ETF, which is XLE, and have, a rough target of maybe this resistance up here at 94, let's say. So whenever you put a trade together, I like to know when I'm getting out before I get in. That's very, very important. We teach that in our community. We have to have a certain game plan before we enter any trade. So I kind of know that up here, I might encounter some resistance at this 94 level right here. So I'm starting to put the trade together. I want to get in here. You can see that it's above its moving averages. It's trading in an uptrend. It's been consistently trading in an uptrend, even though it's had some pullbacks. As recently as this week, you can see it made a high here and it has pulled back into its moving average. So this right here provides a pretty decent entry point. So currently it's trading at 89.63. I'm going to use that price when I select my strike price. Now, again, like and subscribe our channel. There's education like this all the time. But if you want to drill down into more strategy into how to pick the strike prices and the expiration dates and all that other stuff, definitely check out some of our website and our other material that is in the link below. So I'm going to go through this really fast, but you can see here that I'm going to go to an option chain. You can use any brokerage account that you might use, whether it be Robinhood, Thinkorswim, or any of the popular ones here will give you an option chain. You then go in here and you select which strike price and expiration date you might want to get involved in. So I generally like to go out at least 30 days when I'm picking a target here. There's reasons for that, and again, it has to do with strategy. I don't like to get involved with too much time decay, so I'm generally going to pick the at the money strike, which is 89.5 right now, and I'm going to go ahead and select that. And one of the things and one of the strategies I'm a very big proponent of is called the vertical spread. The reason why I like that is because that gives me a little bit of a cost savings. Right now, this particular option contract that I want to buy, by the way, is $1.78 by 264. That's a pretty big spread, but basically, let's just call it $2 just to make the math simple. That's a $200 trade. So you get to control 100 shares of XLE for simply $200. And you get to control those shares up until November 7th, which is 30 days away. The further out you go, the more money you'll pay, and so on and so forth. But for the most part, you need at least 30 days because you want your trade to work. You want your target to be reached. So I'm generally going to pick around 30 days. I'm going to select vertical. Now, when I select vertical, I'm going to go long the 89.5s, which is basically the ones I just mentioned. But as you remember, I did select a target. I do think it's going to maybe get up to this 94 level. So what I want to do is sell a contract against the one that I just bought. So if I buy the 89.5s, and let's say I sell the 94.5s, which is above my target, look what I just did. I just decreased the price of my option here. It's going to cost me only $1.87. So my risk reward profile is going to look pretty good there. I'm going to show you exactly what I'm talking about. I always like to do this, and I always like to make sure that I know how much I'm paying, which is $1.87, which is $187. And then what's my ultimate reward? If it reaches my target of 94.5 by November 7th, my total reward is going to be $313. So I'm risking $187 to potentially make $313. Now, keep in mind, this will last to 30 days. So you can get out of this at any time if it reaches your target. You don't have to wait until expiration. The options trade every single day, just like in the stock market. So another thing you can do is place a stop order. So if you don't want to lose the whole $187, if you're not willing to risk that, you can, let's say, place a 50% stop. So let's say you're only willing to risk $1. So if you're willing to risk $1 and you place $1 stop on this, that basically means that if it goes from 187 down to $1, this trade will get you out. That basically prevents you from losing more than you're willing to risk. So in that case, you're essentially risking $1 to make 3. That's a 3-to-1 reward to risk ratio on this trade. So just to recap really quick, if it does get up to this 97.5 level, up to here, because I do expect it to kind of reach around this area and then potentially pull back, I have 30 days for that to happen. I'm risking $187 only in my account. So think about that for a second. If you have a small account, these are the types of trades that you can make. You're making $300 potentially on only about $1 worth of risk or $100 worth of risk. So if you do these over and over again, you can rapidly build your account size. As long as you manage your risk, don't oversize your positions, and remember that 60-20-20 rule. When you have an account size less than $5,000, there's no sense necessarily to pick individual stocks. You can pick QQQs, you can pick the sectors, or you can pick the overall indexes. So I hope this video is helpful. It's just a little bit of a taste of some of the stuff we do in our community. Please like and subscribe to this channel if you think videos like this are helpful. Also, if you have any questions, feel free to ask them in the description below, and check out our website and the stuff that we offer. Everything we do here is fantastic, and it's great for our community. So have a wonderful day. I will talk to you guys soon. Take care, everybody.